Hey everybody, it's Justin here, America's Honest Tax Accountant with Number Crunch Nerds. Welcome to part 3 of my 2024 tax filing season video series for small businesses and individuals. Let's pick up where we left off in part 2. So we're working in TurboTax. I'm in the Home and Business Edition. We're doing your 2023 tax returns due April 15th, 2024. This is the screen we left off on in part 2. So we're going to enter the rental information ourselves. We are doing Schedule E for rental properties in this video. So I'm going to click continue. All right. Is your property in any of these designated areas? These are like qualified disaster zones, Indian reservation properties. These are things that probably don't apply to many people. So I'm just going to click none of the above and keep going. All right, tell us about this property. So remember in the last video, I said that we purchased this rental property during the year and we're going to rent it for 250 days at a fair market price. So we're going to need some information: date of purchase, purchase price, cost of improvements, mortgage refinancing costs. We're going to be getting these off of a settlement statement. You're going to have in the year that you purchase a property or sell a property, you're going to have some kind of settlement statement, and we're going to look on there for information that will be relevant to your tax return. So let's keep going here. Was this property your residence in the past? I'm going to say no to that. Continue. All right, how did you acquire this property? I'm just going to say that we purchased this as a rental. There's some other ways you can get property, but the most common one is going to be you purchased it. So we're going to go with that. Continue. All right, so current tax bill, mortgage refinance paperwork, other purchase paperwork, receipts for improvements. We're going to get into all of that. Let's continue. Okay, enter the purchase price. The purchase price is the original price you paid for the property. It helps us determine your depreciation deduction. So what we're going to need is something like this over here. Probably you're going to have some kind of settlement statement. They all look different, but for the most part, they have the same kind of information on it. So you're going to be looking for the contract sales price or some kind of similar language right here. And let's just say for this example that we purchased this property for $500,000. And let's say that the available date, meaning when it was available to rent, just to make things simple, let's say it was 4/1/2023, so April 1st, and let's say the purchase date was March 1st, 2023. So you purchased it and then you took a month to either do some renovations, some repairs, do your advertising to get tenants in there or whatever you needed to do. So there was a month of time right there. Continue. Okay, next up is escrow fees. So there's a bunch of different kinds of fees that you may or may not have on your settlement statement listed right here. The best thing to do as part of our work papers is to make a list as well. So yeah, we're going to enter them in here, but remember what we want to do is we want to build out a supporting work paper so that in the event of an audit, which again is not going to be right away, it could be 2-3 years down the road, you want to have all of your ducks in a row. So you want to keep track of all the information that you're putting into your tax return. So we already put in the $500,000 purchase price. For this example, let's just say we have legal fees of $2,000. We're going to do title insurance of $2,500. And then we're going to do $4,000 of expenses that we paid the seller for whatever reason. Continue. All right, any seller paid points. This is not a very common thing that I see, so we're just going to leave that one blank and continue. Okay, any improvements made to the property, so remodeling costs, room additions. Remodeling is a very common thing. I see that a lot, so we'll put in $15,000 for that. Often, you buy a property as a rental. It may not come in the perfect condition, so you have to do some kind of renovation to it. Special tax assessments. Room additions I don't see very often. Special tax assessments, sidewalks, sewer connections. City or local government may add the following in your area. If you are assessed for these, include your share or your assessment here. I don't see this very much, but just for fun, let's throw in $5,000 of special tax assessment. This whole thing is about, are we going to capitalize these costs to the property, meaning are they going to be depreciated over time as opposed to being able to take the expense now. So all the questions that we're going through are all about, are these costs going to be added to the cost of the rental property? So you don't get the deduction right now, you get the deduction over time through depreciation, or are they going to be deducted immediately? So I'm curious to see what TurboTax does with this special tax assessment when we get further along. So we put that in there. Let's continue. Any other payments? Enter any of the following payments, credits, or subsidies that you receive. Let's throw something in here just for fun. I'm going to say we got some energy credits. Let's see what it says in here. Enter the total amount of credits you took for energy conservation improvements, such as a solar heating device. All right, so assuming that we put some kind of improvement into the property that is eligible for one of the energy credits, we're going to take that. Now, that's the kind of thing that's going to be taken away from the cost of the home. So a lot of these costs will be added. This one will be taken away because you already got a credit for it. And so you're not going to be able to double dip and then add it to the cost of your home and then depreciate it and take an expense for it over time. So I'm going to throw $4,200 in there, and we'll check out what happens with all this as we get further along. Continue. All right, and finally, any other adjustments, any increases or decreases to your property's basis. The property's basis, this is what I was just mentioning. Costs that increase the purchase price, basically. So in our example, $500,000, we're going to add some costs to that. The total of that is what's called our basis. So $500,000 is our starting basis. That's our cost basis. Then we're going to add some things to that. Then we're going to take away some things. And finally, we'll arrive at a number that is what's called the property's basis or the depreciable basis. Let's see what other items they mention in here. Legal fees to defend the title, challenge in an assessment, cost of extending service lines. These are not common things. Adoption credits, home buyers credits. If you have any of this stuff, you can throw them in here. For this example, I'm just going to leave these blank. Continue. Enter property tax values. Use the values listed on your property tax bill to find this information. So what is this screen right here asking for, and what is the point of all this? What it's trying to identify is the land portion of the purchase that you made. So let's say you bought a single family residence. Well, some of that purchase relates to the house itself, and some of it relates to land. Now, land is not a depreciable asset. So whatever value is identified as land right here will be taken away from that cost basis or that depreciable basis that we talked about on earlier in the video. The point is to identify how much of this purchase is a depreciable item and land is not depreciable. Improvement value means land improvements. So things that were done to the land to improve them in some way. Fences is a very common example. Let's see what else is in here. Pipes, fences, pavement. Improvements include everything other than the land itself, because improvements are depreciable assets, but land is not. So here's an example. The numbers on here have nothing to do with the example that we're going through. This is just some picture that I pulled off the internet to kind of demonstrate. This appears to be from a county board of taxation. So here is something that an example of what identify, like in this situation, they're saying the land related to this item is worth $360,000. The building is worth $422,900 for a total of $782,900. So if you have something like this that lays it out real clear, like here's the value of the land, that would be really helpful. Unfortunately, I don't think any settlement statements ever really identify what this is. That's probably why settlement statement is not listed here. Frankly, I'm not sure that your property tax bill or your insurance records list it either. This is one of those things where it's very hard to determine exactly what the land value is going to be. Let me show you an example from the IRS. All right, so this is a depreciation FAQ published by the IRS. This is an IRS document. I Googled land versus land improvement IRS, and this was the second thing that came up. So, can I depreciate the cost of land? Land can never be depreciated. Since land cannot be depreciated, you need to allocate the original purchase price between the land and the building. This is what I just said a moment ago. You purchased a rental property, it came with land. We have to figure out how much of the total price relates to the actual home and how much relates to the land. The portion related to the home will be depreciable. The portion related to the land will not. You can use your property tax assessor's value to compute a ratio of the value of the land to the building. Example, Ryan bought an office building. It doesn't have to be an office building. It can be any kind of property like a single family home. This is just an example. Ryan bought an office building for $100,000. The property tax statement shows improvements of 60, land of 20 for a total value of 80. So this is the property tax statement assessed values, but you actually paid 100. And so what they're doing here is they're basically saying, based on these numbers, 75% of the entire purchase is going to relate to the actual home, and 25% is going to relate to the land. And then so what you would do is you would use these percentages against your $100,000 purchase price, multiply the purchase price $100,000 by 25% to get the value of the land, which is $25,000. You can depreciate your $75,000 basis in the building using the mid-month makers tables. We'll deal with that. We'll deal with the depreciation later. TurboTax will show you how to calculate that in a little bit. The point is the allocation is something that you have to determine. Let me close this. Right here, that's what it's asking for. It's telling you have to tell TurboTax what the allocation is. It can't know what portion of your purchase was the home and what portion was land. You have to tell it that information right here. It can calculate the depreciation for you on the portion that is depreciable, but it can't know how much of it related to the home and how much of it related to the land. That's a calculation you're going to have to use one of these things or make some kind of reasonable assessment about how much is land, how much is improvement. So for this example, let's say that I've determined that my land ratio is 20% and my home ratio is 80%. And so I'm just going to take the purchase price multiplied by 20% to get the value of the land. And I'm just going to put that in here, 100,000. And then I'm going to put in the improvement value of 400,000 right there. Let's continue. Okay, depreciation results. Your rental property will be depreciated by $419,440 during the next 27 and a half years. 27 and a half years is the rate at which rental property is depreciated for everybody, so that's standard. Question I have is, do we understand this number right here? Because this is not based on some IRS table. This is the full amount that will be depreciated over the life of the asset. And so it's based on all this information that we put in over here. And so do we understand how all of this information led into getting this number? And it says we can review our rental property depreciation in the next section. So let's go and do that. Okay, in order to see that, I'm going to click right here on the Forms view. And because we happen to be on that depreciation results screen, it is going to take us, I'm going to maximize this, it's going to take us to a handy dandy little worksheet. This is the new rental property worksheet that TurboTax has available for us. So let's go through the calculation. Actually, it would be nice if we could compare our numbers to this side by side. So one moment. All right, I got it worked out. We had to make this sheet a little bit smaller. Hopefully you can still see it. So let's go through the numbers. So here's our $500,000 original purchase price right here. Then it's going to add in our legal fees, our title insurance, the expenses that we pay to the seller. So remember, we wrote all these things down over here. These are all going to increase the amount that we can depreciate. They're going to increase our depreciable basis. Let's keep going down the list here. The cost of capital improvements, meaning the remodeling and all the stuff that we did to the property, that $15,000 is going to increase it. And then here's the special tax assessment that we paid for the local improvements. That's going to increase our basis as well. That's kind of unfortunate. It's too bad you can't just deduct that immediately. I mean, if you're going to get assessed by the city or the county for $5,000 so that they can put a sidewalk near your house or something like that, you don't even get to expense that in the current year. You have to add it to the basis of your property and depreciate it and get the deduction over time. That's too bad. But that's what's happening right here. That is being added into the total increases to basis right here. So $28,000 is the total increase. That is bringing the value that we're going to depreciate up. Then we also have some decreases to basis. The one that we put in was this one right here, the energy credits. Remember I said if you get a credit, you get a tax credit related to like energy efficient property that you put into your rental property and so forth. You have to take that away from the amount that you will ultimately depreciate over time. Otherwise, you'd be double dipping, and the IRS doesn't want you to do that. So that's going to be a decrease to the depreciable basis. We only have one in this example. So we start with the $500,000. We add in the $28,500 right here. We subtract the $4,200, and that gets us to $524,300. But we're not done yet. Now comes the allocation between land and improvements. And improvements basically just means the house. But it could also mean things like fences or concrete or sidewalks or things that are not actually connected to the house, but they're also not part of the land. That's getting a little bit more intricate than we're going to deal with in this example. For the most part, it's basically going to be land versus house. And in this case, they're calling house improvement to the land. So we had an 80-20, if you recall from earlier. So 80% is allocated to the home. So they're going to take this full $524,300, 20% of it is going to go to the land. And that's unfortunate too, because what's happening, instead of getting all of this, being able to deduct all of this, some of it's actually getting allocated to the land, and you won't be able to get to depreciate that over time. You will recover the cost of it if you sell the property, theoretically, assuming you sell it for a gain. You will be able to basically you will reduce the gain by the amounts that ultimately didn't get to be depreciated. Calculating gain on a sale is something for another video, but the point is you don't lose it forever just because it went to the land, but it's going to be basically held up to where you can't get this deduction until you ultimately liquidate or sell the property. But so you'll see, once they do this calculation, 20% of it gets allocated to the land, so you'll never depreciate that. And then 80% gets allocated to the home. That's why the amount that was ultimately going to be depreciated over the 27 and a half years, or and another way to say it is the depreciable basis that you will get to recover over time is going to be the $419,440. So that is how that is calculated. I'm going to end this video right here. That was a great example of getting a new piece of property into TurboTax, figuring out what the basis of the property is for depreciation purposes. And in the next video, we will keep going, adding more information about your current year rental income, rental expense. In fact, we'll go right here to a quick preview. I have all of the items listed out, like we have our rents received, we have all of our expenses like advertising to get a tenant in your property, mortgage interest, taxes, supplies, all that kind of stuff. We're going to keep building out our work papers. We're going to get all the information into TurboTax so we can see what the ultimate rental income and loss is. And then in future videos, we will also get all of that information to flow into your 1040, because ultimately the Form 1040 is what we're going to be filing. That's it for this video, and I'll see you in the next one.